Good afternoon and welcome to the afternoon session of the first day of the third week of the public hearings into the online intermediation platforms market inquiry. This afternoon, as I indicated earlier, we start with famous brands. I'm sure all South Africans will recognize those brands. And then after that, we have Expedia, who were unable to make the first week when we dealt with travel and accommodation. So I would like to welcome Mr. Terry Boardman, who is the Managing Executive for Leading Brands for Quick Service Restaurants, and Ms. Celeste Apollos, the Group Company Secretary and Head of Legal for Famous Brands. Welcome to the virtual hearings. And as I indicated earlier, I'm very happy to use first name terms.
Thanks, James. Appreciate it.
I'm joined by my fellow panel member, Ms. Doris Tsepe, and also some of the technical team who you may have had interactions with, or at least members of your company. Terry, I believe you have a presentation, so I'm going to let you put that up and take us through it.
Thanks, James. I'll get straight into it. Let me just bring it up quickly. If you could just indicate when you see it.
Yes, we can see it.
It's started from just hold on a sec. Technical issues here. Let's start from the beginning, not from the end. Perfect. Okay. So yeah, obviously introductions have already been made. So I head up the leading brands portfolio in terms of QSR, and specifically home delivery and online falls within my department. So that's why I'll be taking through the presentation today in terms of some context around famous brands, but importantly as well, getting into some detail around our own online platform and capability, as well as talking to third party and some forward view points that I'd like to kind of end off with. So kicking off just in terms of the introduction, for those that don't know who Famous Brands is, I mean, we are a branded food services business operating mainly franchise business, but also have a master license and a company-owned restaurant portfolio. So just in terms of how our business is made up, for those that perhaps don't understand, that Famous Brands actually is an integrated business model that comprises of three pillars across these disciplines: brands, manufacturing and logistics. And specifically what I'm going to kind of orientate the discussion around today is obviously our brands, and in our branded portfolio we have 2,813 restaurants trading across South Africa, in the AME markets as well as in the UK. So quite an extensive portfolio in terms of brands. I will, however, for this session be focusing just on obviously the South African context that we have in play at the moment. So just to give a little bit of insight in terms of how our business is structured from a brands perspective, it really is broken down into two disciplines: quick service restaurants and casual dining restaurants are kind of two portfolios that play out within our brands. And that's structured around our leading brands portfolio, which is the bulk of our branded network. And the quick service component of our leading brands portfolio is Steers, Debonairs Pizza, Fisherways and Milky Lane. And then forming part of the casual dining component of this portfolio in leading brands is Mug and Bean and Wimpy. And then we do have signature brands, which is generally our brands that we have either wholly owned or joint venture partnerships with. And you will see brands like Mythos, Lupa, Turn and Tender, Salsa, Volvatello and Fago Cafe, as well as Coffee Couture, really do form part of our wholly owned portfolio here and orientated all around the casual dining space. You will see brands like Paul, our joint venture and under license, as well as you will see House of Coffees and Net Cafe are forming under license agreements in terms of how we operate those particular businesses. And then the other portfolio, we have our branded joint venture with Mr. Biggs in Nigeria, which is a quick service portfolio up in Nigeria. And then you'll see there's a retail portfolio, as you can see right at the bottom, with the likes of Aquamanta, Baltimore, True Fruit, and Gold Seal. So that just gives a little bit of context in terms of how the portfolio looks, and gives you context in terms of this integrated approach we have to our business. I think importantly for this hearing is really to give context to everyone that is watching at the moment, and to the panel around what channels we participate in the market across all our brands. And from a Famous Brands perspective, I mean, not all brands participate in these channels, and these are, as I've defined, the main channels across the group. There are obviously subsets within these channels, so I'll talk to a couple of examples when I get to it. But right now, these are the main channels that we participate in. Sit down, as you can see at the top, being one of our key channels, and really orientated around our casual dining restaurant business. We then also have own delivery as a channel. And this is more orientated and aligned across our quick service restaurant channel. However, it does translate into some of our casual dining restaurants as well. Collect is a key channel that has kind of come to light and seen quite a lot of growth, especially during COVID. And you can well understand that obviously less contact has driven that particular growth in that channel, and there are subsets of Collect. So Collect, as an example, as I said, would be orientated around in-store Collect, but might also orientate around curbside collection, as an example. So there are subsets in terms of channels that sit under these main channels. We then have third party as a channel that we obviously participate in across our brands. We then also have Counter, which is really orientated more around the walk-in consumer, and is focused on really the takeaway part of our business. And then a smaller portfolio of ours, but is a growing one at this point in time, and links back into the convenience aspect and demand from consumers around drive-through as a key channel. And here again, this is not brand specific. It kind of washes across a number of our brands, but mainly focused around QSR at this point in time. So that's just a little bit of context in terms of the channels, in terms of which we participate. Just in terms of giving some context, and I suppose a little bit of a history lesson here in terms of our own online channel. Online ordering was launched within the Famous Brands group in 2010, so we've been in it for some time. And in fact, if you look, we were first to market in terms of specifically online ordering and app ordering within the South African market. This was really driven, I mean, being a customer-centric and customer-focused business that obviously focus around growing our brands by being in tune with the customer. Online ordering was launched really in terms of the growing move to mobile, and specifically web ordering at that point in time, but we saw mobile as a key opportunity, and this was added as an additional channel over and above at that point the only channel available for ordering was telephonic. Just highlighting some of the challenges that were faced around establishing one's own online channel, especially in the early stages. One of the key challenges that came out was slow customer adoption. And here, I think anyone getting into this space, or in fact exploring any new channel to the consumer, needs to understand that generally customer adoption is a journey and takes some time. So really one of the earlier challenges was really to get customers to adopt and kind of start participating on that particular channel. Internet access in the early days was a massive challenge, both at restaurant level, and still remains a challenge to date in terms of some of our outlying restaurants in certain geographies. So internet access obviously critical in order to make online as a channel work, and that still remains a challenge to date. I think coming out of 2010 and even more so, I suppose today, the cost of data is still a hot topic, and still a barrier for consumers in terms of interacting on the channel. So, cost of data for consumers is still a barrier at this point in time, still a challenge. What is important to understand in terms of own online channel is the cost to support and develop it in the initial stages is a barrier to a large degree, because the adoption, as I said earlier on, in terms of the consumer is fairly slow. So you are really investing ahead of the curve and kind of linking into the trends that consumers are kind of progressing towards, and there is an investment ahead of the curve in terms of these type of investments. What is not spoken about often is around the fact that generally technology moves fairly quickly. So there are costs associated with replatforming the online ordering channel that one might develop. And as an example, from a famous brands perspective, with our partners, we've had to replatform our online ordering channel 3 times over the last 20 years that it's been in play. And that's even accelerated even more so now that technology tends to move a lot quicker than it did 10 or 15 years ago. One of the biggest challenges with any channel, but more specifically online, is there's no physical presence in the marketplace. So, staying top of mind in terms of acquiring customers onto the channel, as well as managing churn, is an ongoing challenge that needs to be managed very closely and carefully. A key kind of challenge, and I suppose when I talk to the cost a little bit later on, you'll see marketing of the channel and staying top of mind in terms of driving consumer demand and consumer participation in the channel is critical. So marketing of the channel is both a cost and a challenge in order to get consumers to adopt to using the channel. And then for us as a franchise business, or predominantly a franchise business, we obviously have to go and enable technology across all our restaurants. And as you can well imagine, taking our franchise partners along that journey in terms of enabling all the technology, both software and hardware, that's required in order to affect online ordering is quite a journey and quite an investment on both parties, both our franchise partners and ourselves through the process. Just balancing this slide off with some of the costs that are associated with own online ordering capability is we know that in a lot of instances online ordering is kind of subject to last mile in terms of driving demand for consumers. So consumers are looking for last mile delivery, so online ordering is subject to that. And I suppose, like anything, the costs associated with last mile, we're not talking to in this specific instance. But if you look at the technology, every order that comes through the online platform has an order processing fee that's associated with it. And that's obviously to facilitate all the technology that's required to get that order down to a restaurant. There are also platform license fees that are in place, and this is specifically fees around things like geolocation license fees, fees around reporting, fees around bandwidth and redundancy, etc., that are put into place to support the platform. Other key costs specifically are around promoting on the online space. So generally to get adoption, as we well know, you have to go and promote quite actively with consumers to get them to trial the service, and there's costs associated in terms of promoting online, either through activations or through promotional activity that will drive consumer change in behavior. The other element around our business, specifically associated around costs, is obviously building up competencies and skills, both at a central perspective, at a brand perspective, and that's around particularly upskilling people within the organization to be able to manage online, to understand how it all hangs together. And that translates right down to our franchise partners, who have to upskill their managers, upskill their staff to be able to deal with technology and obviously a new channel from that perspective. So we've found that there's been a lot of investment around building up those competencies and skills, both centrally within the group, but also right down to restaurant level. Another key component that is associated around costs is around capacity, and I did highlight the fact that last mile is critical in terms of driving online sales. So from a capacity point of view, obviously servicing the consumer with last mile is key, but we also refer to the capacity that needs to be invested in terms of the volume growth that tends to come through online. So there's an ongoing cost that's associated in terms of building capacity to handle specifically peaks at month end, etc., that kind of push through huge volumes from a capacity point of view. The other costs associated, and these are specifically the costs associated around what the brands need to invest in, are orientated around marketing these particular channels to get adoption and to obviously establish the brand as a brand that participates in this particular channel, and keeping it top of mind, so that when consumers are thinking about a particular brand, that they realize there is an opportunity for them to interact online. Another key cost component is to continue to grow the database, and this is ongoing kind of commitment, and this is through customer relationship management, or through direct marketing to that consumer that is on the database. So, growing the customer database and maintaining it really does come with its own associated costs. So I hope that gives a little bit of insight in terms of our own online channel capability, challenges, and costs. I'd like now to talk a little bit around multi-homing, which has come up as, I think, a key subject in the inquiry. And here, just to highlight in terms of how Famous Brands interacts and participates in terms of third-party platforms. I mean, all our brands can participate on one or more third-party online platforms, so that's from a brand perspective. I will go into a little bit of the detail now in terms of how that plays out. Probably the one kind of condition that this does orientate around is that we do approve which third-party platforms we participate on, and that's done through ensuring that they meet minimum criteria that we've set out in terms of participation. But I'll get into a little bit of detail towards the end, just giving you a little bit more insight there. Participation on third-party online platforms is quite clearly subject to whether that service is represented in a certain geography. And as you well know, we have lots of brands that trade across the geography of South Africa, and not all third-party platforms do service all the geographies in terms of which we trade in. There are no exclusive arrangements with any one third-party online platform. So from Famous Brands perspective, there is no exclusive arrangements with one third-party platform. Very importantly, we are a franchise business, and our franchise owners are not mandated to participate, so they have the ability to choose to participate on third-party platforms, whether it be one or two or none. And the choice is theirs in terms of participation, and they obviously have the ability to make that choice in terms of what's best for their business. And getting to the last point, which is quite a key point, what we continue to do from a famous brands perspective, and we have the resource in terms of our home delivery portfolio that is housed within QSR leading brands, is to continue to assess and trial other third-party platforms in order to see if we can reach new consumers. This, as I said earlier on, is subject to the criteria that we've set out, and it specifically is orientated around how those platforms are able to represent our brands and, more importantly, to service our customers that want to buy into our branded product on their platform. So those trials and assessments are ongoing in terms of looking at other third parties that may be able to participate with us. Just to give a little bit of insight, and I'm sure this is well known, as we know from a COVID-19 impact point of view on the famous brands business in our restaurants and our franchise partners. As we know, May 2020 was opened up for delivery only due to lockdown restrictions. And to a large degree, this really did drive online adoption and accelerated it quite considerably. So that was a big drive for us, which leads me to my next point, which is really around the fact during May 2020 up until January 2021, we saw within our business a doubling of volume, specifically on third-party online platforms versus prior year. I think what's important to note here is generally this did come from the onboarding of more restaurants and from the third-party platforms expansion geographically into new territories as well. We know that sit down in this particular period of May through to January, in fact, even during the course of the big middle of this year, the sit-down channels were impacted due to restrictions, but more importantly as well, the consumer health concerns still remained a barrier throughout the period, and that seems to be changing. When I get to the forward view, you'll see that there's a bit of a shift in terms of how the consumer is feeling from a health concern perspective. From our counter channels, we've been down on feet volume and up on spend. So people have been coming in less often, but spending more with us. And obviously, counter is a key channel for us in terms of our takeaway and our QSR business, and does quite significant volumes. And during COVID-19, consumers were obviously shifting to more low contact channels like counter, online, etc. Just in terms of giving some flavor and a forward view in terms of how we see the future playing out within our sector, is we believe that the customer will return to sit down and counter channels, and we're starting to see that happen already. We do anticipate that they will still visit us less often and spend more, and there is some kind of pent up I suppose demand for I suppose for consumers to kind of connect on a personal and a physical level. So we see sharing occasions also growing within the market over the short to medium term. There's no doubt that we see remote convenience continuing to grow, and convenience overall for consumer will continue to grow into the future. We do anticipate that online platforms, in terms of their growth that they had since COVID-19 launched, and the acceleration that I mentioned earlier on, will start to slow, and specifically here from a like-on-like basis, restaurant on restaurant, we see that growth slowing significantly, and most of the growth likely coming through new geographies and expansion and onboarding of more restaurants rather than like-on-like. From a channel mix and split perspective, and if we look at our business specifically, we don't see this returning to pre-COVID levels. Here we see the mix and the split across all the channels kind of remaining in the new baseline, although we do see sit down and counter, as we said, returning to a large degree. But in terms of the actual split that was there pre-COVID, we don't see that remaining as is, and we do see shifts happening across all our channels. And that really brings me to the end in terms of what I just wanted to give from a context point of view, and hopefully I can now answer some questions. I'm going to get out of the presentation if you don't mind, so I can see everyone clearly, and then happy to take some questions. Thanks.
Thanks, Terry. And before we start the questions, I'm sure you've been reminded, but we are in public sessions, so don't traverse any confidential information. Can I start with basically where you left off and how the mix and split will change? Now, we don't necessarily need the exact for each restaurant, but I mean, can you give us a little bit of flavor for quick service restaurants, which I assume is your area, how you think that mix has changed? I mean, you've said more counter, more maybe online, less contact, but is it possible to give us some sense of the mix between in-dining, counter, which is takeaway, and online?
I'm probably not able to give the exact split from a percentage point of view, because I think that would kind of give away in terms of, I suppose, the competitive aspect. But I mean, if I could answer that from the perspective in terms of where do we see the growth coming in certain channels, I mean, there's definitely growth starting to play out in terms of, I suppose, a rebalancing across sit down and counter. So that's coming back to similar levels that it was pre-COVID. Although, as I said earlier on, customers are coming less but spending more. So there's a little bit more indulgent, there's a little bit more around bringing groups of people together, enjoying each other's company. So there's a shift in terms of that particular need from a consumer point of view to connect. And we see that kind of playing up to similar levels, as we said, less frequent, but obviously spending more. We continue to see the fact that, you know, channels like drive-through, which is around convenience, home delivery, online, and even third party will continue to enjoy support. What we do see happening though is probably a little bit of a pullback on the growth that those particular channels have seen over the COVID period, which was really driven by, to a large degree, health fears and restrictions. So, you know, we don't see that returning back to, or seeing the same growth potential that it had over the period. We see that slowing down to a large degree, and other channels growing and balancing out. So I hope that answers the question to some degree, James.
Yeah, no, and I think it helps just orientate us, because obviously also COVID has been such a major event in all our lives that sometimes there's a question whether we can compare the pre-COVID period to the post-COVID, if there will be such a thing. But as I understand you, there's going to be a little bit of a shift, a new baseline. We can't just look back at that period. I mean, I just wanted to...
I suppose just to kind of, I suppose, clear up a little bit. I mean, we don't see a fundamental shift in terms of the mix once, you know, COVID starts to subside. So I think just to reinforce that the shift in channels is not fundamentally going to change to such a degree that it kind of turns on its head, if that makes sense.
No, that does, and I think many of us are very grateful to be back in dining and experiencing some friends' company. I mean, on that, you know, we've sort of been presented with these ideas of the customer journey, almost, you know, how do I end up on dine-in versus delivery versus counter? And it seems there are many customer journeys, and I, as well, a fan of some of your brands. Sometimes I'm ordering takeaway and picking up from the counter. Sometimes I'm dining in. Sometimes I'm ordering delivery, and they're not mutually exclusive. But I mean, in your business, how do you understand these sort of consumer journeys? Maybe if you can give us insights, because you must think about them, I'm sure.
Yeah, so I mean, critically for us, as I said during the presentation, is we are consumer led. So, a lot of the research and trends that come out and understanding our consumer in terms of what their needs are vitally important. And as I said, we do invest a little bit ahead in terms of making sure that we are there for the consumer where they want to shop, when they want to shop. So that's an ongoing process strategically that we apply to all our brands. And not all of them, as you know, are able to leverage and to participate in those consumer needs. But where we are able to, we obviously strategically put plans in place in order to participate. I think the key here coming out of what we've seen over the years is it's not anything but the sum of the parts. The fact is the consumer has choice. They have lots of choice at this point in time. They are, if any brand thinks that they're in the driving seat at this point in time, would be mistaken. If anything, you're in the passenger seat and you better strap in and enjoy the ride. So in a lot of instances, consumer needs are driving the demand in terms of where they participate. But as I said, it's the sum of the parts that really adds up to the overall business being successful, because you have to participate in many of those channels and as many, I suppose, of the choices that the consumers want to make in terms of how they want to interact with you. So it's not a one size fits all to a large degree. So I hope that answers the question.
Yeah, I suppose the way I've been trying to think about it, and maybe you can just give your view, but there will be times I want to pick up at the counter, and so you have to have that service. There will be times I want to sit in, you need that service, and there will be times I want to delivery to my home. So if you're not there, you're not part of my decision, and you may lose to another one. So my state of mind may be in one of those three, and you need to offer all three or four if you're going to contest for my service compared to another chain,
And that's 100% correct. And that's our view, is to participate. And as I say, if the customer wants to make a choice, is to be available to them as on many channels as we can be.
And so I suppose if drive-through is one you flagged as potentially, growing, that maybe you invest a little more just to make sure you have more presence. But that would seem then the sort of way you're approaching it, the way you've highlighted all the different ways that you interact with the consumer.
That would be correct, yes.
Terry, I was interested in your slide around all the costs and challenges of setting up your own platform. And, we've obviously had the benefit of interacting with many restaurant chains and platforms themselves. But, I get a sense that, much like you've indicated, setting up on-demand last-mile delivery is not easy. It maybe seems easy when we bang into an app, but getting food out within a certain amount of time from a restaurant near my location with the right order is a massive challenge. And I think you've indicated that. If I can just understand, I think Debonair's and Steers have their own apps and online ordering. Do you have it for all your quick service restaurants that you listed?
Well, majority of our restaurant chains, and even in the casual dining space, do have apps. So, in fact, the whole Leading Brands portfolio has apps, has web, has other channels like ordering ahead, loyalty that are built into this app. So yeah, we've participated and built capability around specifically being in the online digital world. because the customer at this point in time, as you know, is between physical and digital, and they're kind of migrating and moving between both of those worlds continually. So yeah, we participate on all our leading brands with apps and web ordering, and as I said, other elements as well.
So that's what I just want to understand. If you've got the capabilities, what is the purpose of using the third-party platforms for you as Famous Brands?
Probably the best way for me to articulate this, James, would be to articulate it in terms of what traditionally restaurants haven't really participated in or been very good at understanding, is what FMCG is kind of all around, and what retail is all around. So if I kind of refer to and use the analogy of bricks and mortar, if you're not on the shelf, you don't participate in those retailers. And that's really the view that we've taken in terms of how do we be available to the customer. And as I say, if you're customer led, you've got to make those decisions in terms of how do you put your product on the shelf. So third-party aggregators for us is not about us, trying to, I suppose, do anything but tap into a consumer that's shopping in that particular space. And we have taken a little bit of a retail view in saying that we want to have our products on the shelves. It's not so much about brand building or brand awareness or any of that, because our brands are established and we've done that job on our own. But what we do want to be is in the consideration set of the consumer where they shop. And I suppose, like anything, the principles around how you would, if you were a bricks and mortar retailer and you were trying to negotiate with, putting product on your shelf, there would be kind of an agreement in place in terms of how that would look, what the terms and conditions would be, what space you would get, etc. And that's kind of how we view it and how we negotiated around it, is almost with the retailer mindset. We want to be on the shelf. We want to be available to the customer. The customer is shopping there, and that's how do we then manage that strategically in the long term.
Yeah, and that would be my understanding, that if those platforms are drawing customers and those customers are ordering on those platforms, if you're not there, you're not contesting for that order against McDonald's or Burger King in the case of, say, Steers. Is that right? That its customers are there, so you want to be on the shelf, much like the retailer?
No, that's absolutely correct, James. That's right.
Can I just ask about also trying to get customers to your platforms? Because if I looked at your challenges and costs, the one thing that comes up almost repeatedly in a few places is marketing. So online promotion, marketing, and you talked a bit about making yourself top of mind, trying to retain the customer. So how important is marketing in this whole online delivery world?
Well, I think it's critical, and I suppose the challenge with online is, a physical presence is easy if somebody's driving down the road and seeing you every single day and they're aware of you. But in the online space, as soon as you turn off the taps in terms of reminding the customer around the service and the offer, they're not going to remember that service is available to them. So it is an ongoing, I suppose, uphill kind of struggle in terms of staying top of mind, and it's a continual investment on the basis that you've got to keep investing behind it. And I think it's also, it's not just around the investment part, but it's around, kind of what occasions you go and how you're resonating with the consumer. So there's also that aspect in terms of, really connecting with the consumer, solving their problems at the end of the day is quite critical in terms of really getting breakthrough. So it's not only cost investment, there's also lots of sweat and capital put in from that point of view to get consumers to buy in. There's one thing to spend money. If the consumer doesn't buy into it, it's really just a waste. So we spend a lot of time, trying to understand what the consumer needs are and trying to solve for them, give them the solution, make it easy for them to make the decision. So that takes a lot of time and energy and investment.
And I suppose, what we've observed at least is in the online channels, and this is maybe not unique to delivery, but online marketing becomes important. I think you promoting online was one of your points, be it Google or other channels. I mean, is that what you've also found? Because I assume, look, before the online world, you would be on TV, you might have some billboards, you might have other advertising means, sort of above the line, so to speak, I think. I mean, is there a different focus in the marketing spend?
That's been coming for years, James, in terms of the shift to digital and social. So, from a mix perspective, I mean, TV still remains the biggest channel for us to kind of reach our customer. But when you're trying to talk about specific occasions or where the customer is in the digital space, you have to have a digital presence. And as I said, you've got to invest behind it. So we've seen the investment in digital and social marketing increase significantly, probably over the last 5 to 6 years, as it's kind of shifted. And as you need to connect and engage with the consumers in terms of where they are, is the importance of that has grown over time.
Just in terms of directing consumers, I mean, our sense, and that's what I'd like your input on, is an aggregator or third party platform aggregating across many restaurants, I suppose, has the advantage of advertising for a much bigger audience than a single group or a single chain. So potentially able to spend more in these channels and catch the sort of eye of the consumer. I mean, maybe if you could give me your sense from one of the as famous brands and a few of the chains that you have.
Probably the best way for me to kind of put this across would be the fact that there's always going to be space for consumers to deal direct for a number of reasons. I mean, one, the brand owns the customer experience end to end, so there's accountability end to end for the consumer. And in a lot of instances, I mean, in those branded apps, we offer additional value to our consumers in terms of both product offering, promotions, loyalty, etc. So there are reasons for them to participate direct if they so choose. But I think, like anything, there is a space for consumers to not to be loyal to a single brand and to kind of shop across a portfolio of restaurants or products. I think that has become the way of the world. But I mean, there is still a need to a large degree for consumers to be able to interact directly with brands and to experience those brands end to end in terms of the entire experience. As I said, both from how it's kind of displayed, what's available to them, what added value do they get by interacting directly with the brand, and as I said, looking after the experience end to end. Is in control of the brand when they have their own apps online presence. So I think it's important to have both, to be honest. I think consumers tend to shop around where they love a brand and they're loyal. We see it on our platforms, and then they're very loyal and they love the brand and they're fans of the brand. So they want to be able to connect with that brand on a singular basis rather than kind of on the basis of shopping around and have no loyalty.
Yeah, and I mean, you're probably right. I suppose, we had an earlier discussion, this was more property, but a lot of consumers want the variety and then will make the choice. And I suppose when you're on the platform and I've ended up choosing, let's say, steers, I may not jump out of that platform to go and order directly on your app because I went in with a variety. I mean, is that also a fair comment? Because variety seems to also play a role with consumers, and that's why they're popular.
No, absolutely. And I think I highlighted it earlier, and the consumers do want choice. So there is an element of that. But as I said earlier on, where customers are loyal and they know they can get directly and they feel like steers, they get direct, in terms of that particular fan buying into the brand, buying into the experience. But I think what we got to understand is there's, the brand generally in the consideration set for consumers is fourth down the chain in terms of how they consider. So I mean, first, consumers will decide, how they, what the occasion is that they're looking to service. So whether it's feed the family, friends night out, etc. So they look at the occasion first, and then they look in terms of how do I want to interact to access that particular need from an occasion point of view, and then it might kind of move into, do I go online, do I go through drive-through, do I go to store to collect? So that's the next consideration that needs to be made in the chain. And then it gets to cuisine. What does everyone feel like? Do we want chicken? Do we want burgers? Do we want pizza, etc.? So it then gets orientated around that. And then the last choice is, okay, we've chosen pizza. What's the brand that meets our needs and has the value, the offer, etc.? So brands tend to be quite, I'd say, far down the chain in terms of consideration if you take that kind of customer journey into account.
Yeah, and I think that was probably the customer journey I was looking for earlier, but that definitely helps just to understand I suppose, the funnel, or some people call it. I just want to go to your interactions with these third-party platforms, and maybe just start with the sensitive issue of commission fees. I just want to understand, first of all, how negotiable are these when you join, and how negotiable are the increases each year?
So I think importantly, commissions are always going to be a hot topic. No one really wants to pay commissions to any degree, no matter what the value of that commission is or what degree that commission is set at. I suppose the challenge around negotiation is there's, everything's negotiable to a point in time. The approach that we take with third party, and in fact with all our vendors and suppliers, is trying to understand what a fair deal looks like. We're not in it to be cheapest in market, but what we are looking to is understand the fairness in terms of those applicable commissions. We do have the luxury of understanding specifically the total cost of ownership of, as you well know, online delivery, etc. So we have our own view in terms of what the costs associated with, and like anything, those negotiations are based with that in mind. And what we are looking for is a sustainable model in terms of the long term. I suppose the challenge that we have with all, I suppose, the third-party platforms currently is that there is no long-term commitment to those commissions. So whatever is negotiated at a point in time is never in the long term. And importantly, we also don't know, what the cost drivers are in those particular business, because they haven't been, I suppose, shared with us in terms of what those cost drivers are. So it makes it very difficult when you in a strategic partnership, which is what we see third party as, like we see many of our other strategic partners, to drive the consumer need and obviously their requirements, is how these commissions determined for the future, I suppose, is the big question for us. And right now, I suppose like anything, a fair deal is, when both parties are slightly unhappy, and where we are currently is we're slightly unhappy, as I'm sure the third party platform operators are as well.
But as I understand your point being that you haven't negotiated fees that apply in the long run. It's a fee for a year and then it's changed, and your uncertainty is, where is this going? Is that right?
Well, that would be 100% right. I think that's probably been raised on many occasions in terms of, where where's the end game here in terms of fees. And as I said, we've got agreements in place. Those agreements are for a period of time. But I suppose, like anything, I think what's on everyone's mind is, what do those fees look like for the future? And as I said, we understand the total cost of ownership, so we know what's fair. And I suppose that's what the negotiators all around is ensuring that the fees are fair and sustainable for all parties. So we try and take that approach, but we don't have long-term agreements. In fact, I don't think any of the third-party platforms out there have entered into long-term agreements with vendors out there, as far as I'm aware.
And just from what we've been, reading in the press and some of that commission is going to be put into a menu price, which makes sense, and some of it may be absorbed. We can obviously go online with your platforms, but I'd rather just ask, do you absorb some of it and put some into price? Consumers should expect to pay a little more to get delivery to their door.
No, that's correct. We have quite a balanced view. I think as I kind of alluded to earlier on, we try and take a fair approach in terms of the consumer's got to understand they probably need to pay a little bit more for the service in that space. But importantly as well, we don't want to push pricing to the degree that the volume and the value is not there. So we're trying to balance that across the board. Importantly as well, we are a franchise business. So what's very important to us is looking after the profitability and the sustainability of our franchise partners. So, we kind of balancing it across what the brand needs are in terms of driving volume and presence on a particular platform. But also we're balancing it against the consumer, and we're balancing it against our franchise partners. So really those three stakeholders are considered in terms of how we determine pricing and how we share those costs and the rewards that come out of participating in a particular channel.
And I think you raised an important point. Your franchise partner, because they're invested in that store and that's their sole business. And so the profitability, etc., affects them as individuals. Just so I understand, so would it be that if your brand is represented on one of these platforms, you've sort of got a price nationally? It's not the franchisee determines the price, but obviously in determining that price, you might have engaged the franchisees just around where the balance lies.
No, absolutely. We do determine pricing from a brand and a national perspective, so it's not determined by our franchise partners. But importantly, we have a national franchise forum for each of our brands. So we engaged with those franchisees that have been voted in by their peers onto that council, onto that franchise forum, to input into specifically profitability and how we manage that business model. So it's very engaging from that perspective, and as you can imagine, lots of robust debate around how do we balance between consumer and the franchise partners' needs and profitability. So yeah, very robust and very thorough. But that keeps us in check and keeps us honest and keeps the balance in play at the end of the day. So that's our approach to handling that dynamic.
Yeah, and you can't have unhappy franchisees, otherwise they may leave. Not
at all,
yeah. Terry, can I just ask, the other factor obviously going into that is what are the commission fees? So how you balance what you absorb, what you add to the menu. If you had a kind of 10% commission fee, you may look at that balance differently to if you had a 30% fee, for instance. Would that be fair as well?
No, that's absolutely fair. But I suppose, like anything, when you're looking in terms of, what is a fair fee, we also look at it from the point of view that if the fee is too low, specifically, we've seen some fees in the marketplace with some third-party platforms that are not sustainable. The cost to operate end to end, both the technology stack as well as the last mile, and those fees can't sustain the long term. So there's also that instance where we know some of those fees are probably just about buying market share rather than sustainable. So we're not going out for the cheapest, we're going out for what we believe is sustainable and fair in the marketplace at this point in time.
Sure, but I mean, I suppose my question was just if you, well, I'm not going to ask you your fee, but if you had to pay 5-10% more, you might, I would assume, put more on the menu price, maybe as a proportion of the total fee.
We might have to if the fees continue to go. I mean, someone's got to pay for it at the end of the day. It can't only be the franchise partner. So they have to be shared, as I said, across generally the three parties. Brand to some degree funds some of the stuff. Franchise partners funds part of it. And obviously the consumer would have to have their equitable share of those costs.
I mean, as I understand, the sort of initial value proposition from a third-party platform was we're going to bring you some incremental customers. And so maybe we look at it on an incremental gross profit margin basis. I mean, is that still the case, or has COVID changed that for you?
Well, I suppose the principle around incremental is that you never had it before, and once the baseline is kind of built in, that becomes the norm. So for the first couple of years, it might be incremental, and then it gets baked into your business model and becomes the new baseline, as I kind of referred to in my presentation. So incremental doesn't really apply from that degree. It becomes about how do you access a particular consumer, in my viewpoint, rather than this view of incremental. It's if the consumer's shopping there, how do you participate? Really would be the lens that I'd place on that versus incremental. Incremental initially nice to have, but as things settle and as it becomes the new baseline, it's no longer incremental in my view.
Yeah, and I think we've had a few responses from chains kind of saying that, it is taking away from over the counter, or so as a proportion of the business, it is changing. It's no longer just incremental; it might cannibalize a bit.
I mean, cannibalization is one aspect, but I suppose like anything, COVID has, as I said, accelerated some of those shifts in particular channels because of health concerns or restrictions. So it would be difficult to look over the last period and say it's fundamentally shifted the mix because of anything but COVID driving that. And as I said, we're starting to see the balancing across the channel mix in terms of sit down and counter coming back. I think the important part, James, here is just to understand that like any channel or any part of the business, brands and even individual operators need to invest around the channels that they want to grow and have their customers participate in. So, we look at it from the perspective, well, if a particular channel is down and there's been no investment from a brand or an individual to try and drive that particular channel, and third party are doing all the hard yards in terms of driving awareness and trying to get customers to participate on that channel, we mustn't be surprised if there are shifts naturally because consumers have been kind of marketed around a new channel and no one's doing anything about anything else. So I think we're not spectators in this particular event. We have the ability to participate and influence the consumer as well by putting up a hand of what's available to them.
I mean, we did get a response from some of the platforms that this is a small part of the overall pie, and therefore I suppose it's not going to affect margins that much, the commission type fees. I mean, can I just get a sense from your side? You're probably looking at quick service restaurants with all the channels, and and they may have different economics behind them. But I mean, is what happens in third-party delivery relevant for your margins and something you keep track of?
Well, I think like anything, we don't take anything like channels that seriously, and we address our business very strategically in terms of how we manage all channels, no matter how big or small they are. To a large degree, I mean, focusing on the profitability aspect around channels is not all channels are created equal. And there's different cost structures related to certain channels. So as an example, I mean, collectors, quite a favorable channel because the spend tends to be a lot higher, customers doing their own logistics in terms of coming, collecting. So from that perspective, not all channels are created equal. What we try and do is really understand, what the margins look like at a transactional level across those channels, and really ensure that there's enough margin to ensure sustainability for our franchise partners in their model. But as I said, it is the sum of the parts. So the mix is key, and how you influence that mix, and how you promote other channels to perhaps counteract the shift in a particular channel because it's been on the decline, because it hasn't been focused on, etc., is what we try and drive strategically. So it's a combination of some proactive approach, some strategic approach to how we manage channels, but importantly, we have a very clear understanding of what a like-on-like kind of apples with apples comparison is in terms of how those channels are created differently, and how we manage it. So we've got a very clear view in terms of how we manage those channels, because they're not created equal.
Thanks, Terry. I've just got a few more questions because we have our next participants joining us virtually. But I just wanted to discuss the negotiations. I mean, as you said, it's a negotiation, it's a relationship. Let me maybe just ask our guest, Jean-Philippe. I don't know if you can. Oh, right. Technical team.
Hi.
Hi, Jean-Philippe. We're just finishing up with another participant. So I don't know if you want to just put your camera off for now and your mic on mute, and hopefully we'll be with you quite shortly. But apologies for for taking a little extra time. Sorry, Terry. So I mean, a negotiation is about what are the different parties bringing and the value, and finding that deal space, I suppose. I mean, you do have a lot of franchisees, as I understand from your presentation. Is it a predominantly franchisee business?
It is predominantly franchise. That's correct. Yes.
But just in that negotiation, you can't commit your franchisees. But I would presume, if you're looking for a better commission, you're going to at least have to give a commitment how you can bring them on board. Because if there's absolutely nothing there, why give you a better price or better terms? So maybe if you can just talk us through almost how one at least brings those franchisees on board, if that's the negotiation you're trying to enter into.
Well, I think foremost we engage, as I said, with our National Franchise Council with these type of decisions. So we bring all the facts to the table in terms of where we are in the negotiation, and how we're going to manage the particular channel or the vendor. And that applies not only to third party, it applies to all the decisions we make that impact their particular business model and bottom line. So we're very cognizant of getting their input through the process. As I said earlier on, those discussions will be robust because we are trying to balance the consumer need as well as what the brand strategically is trying to deliver on, in the short to long term. But I think importantly, those negotiations are almost agreed with our National Franchise Forum around the principles of how to be managed and what the impact to them is. So there's buy-in up front before we do a final kind of sign-off on those agreements. And we take our franchise partners along the journey with us. So it's not a mandated, we go off and negotiate and send them the rates and say, good luck. There's an active participation on their part as well in terms of inputting into it, as well as how we manage those channels from a marketing point of view, from an offer point of view, from a pricing point of view. So that's all taken into consideration to ensure, as I've said all along, sustainability is key for our business and our franchise partners. They are our route to market, and they're very important to us. So very important that we engage with them around these decisions.
Yeah, and that would be my understanding, as you say, when you've got a National Franchise Council, that you want to bring them along. So they've bought into this, and hence they should support it. Otherwise, they are in the good luck situation, as you put. Is that right?
That's correct. Thanks, James.
And you did mention, sorry, and I don't know if you came back to it, you said you do approve which third parties you participate with. There were some minimum requirements, and you said you might come back to this, but I don't think you did. I mean, maybe if you could just give us some insights for that, and whether that's also part of the National Franchise Council sort of discussion.
So, I mean, as I said, the QSR Leading Brands portfolio has housed in it a home delivery department that obviously has some expertise, and we obviously getting inquiries and engagements from many other third-party platform providers. We only listed with 2 currently, but I mean, over the last couple of years, we've engaged with many of the other third-party providers out there. And we do assess them across a couple of criteria. I mean, one of the key criteria is obviously the platform user experience. So we assess that as a starting point in terms of how our brand would be displayed and what our customers would go through in terms of interacting on that particular platform. We do look at aspects like the ability to offer agile and effective menu management capability. Very importantly, the geographic kind of spread. Do they service our brands and our portfolio to a large degree? So there is the geographic presence consideration, as well as what have they got in place in terms of, because a lot of it, as you know, is orientated around the last mile component, around driver training, support, in terms of query support. And then what we tend to do, James, is to go into a physical trial with these providers once they've met some of that prelim assessment in terms of meeting those criteria, is we'll then put them into a trial and we'll then see what the customer rating kind of performance is. Are they able to generate sales for those particular outlets and those brands? What type of support are they offering our franchise partners around queries, etc. So we get feedback from our franchise partners. We get feedback from our franchise partners in terms of how their driver performances, in terms of the standard that's been applied in terms of driver performance. And that's really the basis in terms of how we make some of those assessments. And based on that, we'll then make the assessment whether we're going to pursue them. Because, I mean, probably the one thing that isn't spoken about or understood clearly here is, when you have a strategic partnership with any of your vendors, and specifically third party, it does cost money from an effort and energy point of view in terms of the brand teams managing that. As I said, the home delivery department managing that relationship. And I mean, we have monthly and quarterly reviews with these strategic partners, both third party and other. So there's investment of people's time and energy in terms of how do we manage that platform, or how do we manage that relationship strategically. So this is not an autopilot. You put them on the platform and you hope for the best. We actively manage those relationships, and when there's any issues that arise, that's kind of forwarded through our National Franchise Forum. We table that with them, we address it, we work through those issues with them. So it's active management on an ongoing basis, which takes time and effort and energy from lots of people across the business. And that's why we're very selective in terms of who we bring on board, because it is about an investment in time and energy. And strategic partnerships should be about that. They should be about a commitment to each other in terms of developing the business in the long term. So I hope that gives you some color.
Yeah, no, it definitely does. And based on that color, I mean, I suppose you're trying to protect your brand. And so, I mean, I would presume you wouldn't give a franchisee carte blanche to join whoever they want. You want to be part of that. As I understand this, what you're saying, you want to assess from head office, and ensure that it fits. I mean, just my last question. I mean, I'm sure you're aware we heard from some quite sort of localized, let's say, delivery platforms last week, and a few had challenges from Eskom in getting to us. But are you looking just for national partners? I mean, or is there a role for local?
Well, there probably is a role for local if they can, I suppose, display that they're tapping into consumer that we're not tapping into. The luxury that we have is that we do have our own capabilities. So to a large degree, we're servicing many of the markets that nobody, has even got on their radar currently. So if you're going to look in terms of our geographic spread across the South African landscape, and in terms of how we're servicing those markets, for someone to come along and say, I can do, third party, when we say, well, we're doing a great job where we are, and unless they can bring tap into a new consumer, and as I say, consideration, because the consumer is shopping there and that's where the need is, it's unlikely that we'd look at it at this point in time. That being said, I mean, what we're open to and what we continue to do is have an open door around assessing any platform out there that approaches us, and in a lot of instances, trialing them and seeing, if they can deliver on what they promise.
All right, Mr. Boardman, let me just check with my other panel member and technical team. I think those are all the questions we have. I thank you for coming and giving us some of your valuable time to get some of the insights. So, sorry, I'm getting some feedback here. So, Mr. Boardman, thank you very much for your time, and I wish you all the best. I know it's been a brutal period for the restaurant industry. I'm glad your franchisees are still in their feet, and hopefully things improve. So all the best for the upcoming festive season.
Yeah, thanks. Appreciate the wishes, and all the best with the rest of your inquiry. And best of luck to all of you. Thank you.
Thanks, Mr. Bourne. And now, if I can invite Mr. Jean-Philippe Monod, if I've got that right, back into our room.
Yes, you have that right.
Well, it took a bit of training in the break.
Well, actually, despite my very French name, I'm actually Dutch.
Ah, interesting. Very
so to
interesting.
Make it very interesting.
So, Mr. Monod or Jean-Philippe, you're from Expedia. I want to thank you for making time to come join our public hearings and provide insights for us. I think there's probably a lot we can learn from an international platform such as your own. I am joined by my fellow panel member, Ms. Doris Tsepe, and she's going to just proceed with some questions, and then I'll join in later if there's anything that hasn't been covered. But I do believe you have a presentation, and so why don't you start with that, and then once you've finished, we'll proceed with questions.
Okay, so let me see if I can get this to work.
Yeah. Jean-Philippe, it seems you've frozen from our side. I don't know if you can still hear us.
Can you hear?
You froze for a while, but in a very dignified manner. You'll be pleased to know.
Thank you very much for that.
But
I've seen worse. So let me try again. I don't know what happened. I was trying to share and then everything froze. So I'm coming back to this right now. Please let me know if you can see the presentation. Can't display content. Oh. Let me just try again. I keep getting an error. Do you need to provide me with permission or?
I'm not the most technically minded myself, but I've just asked the technical team here to see if they can't put it up for you.
What's happening here?
So we're going to see if we can put it up for you, Jean.
Yeah, that would be.
And then you can just indicate when you need us to move to the next slide. So let's just see if the technical team can get that right.
Let's try that.
James, might it be easier if I share, because I think you've got a
if you could.
Version. Okay, I'll do that.
All right, thanks, Jean.
Where is it? Okay, presentation mode.
Yes, wonderful.
Okay. Slideshow.
Yes.
Thanks, Jean. We can see it. We don't have it in presentation mode yet, but at least it's visible.
Something also.
Yeah, well, that's better than I could arrange from here. So while we wait to get to presentation mode, let me introduce myself. So Jean-Philippe Monod. I am responsible for Expedia Group's global corporate and government affairs. I'm based in Brussels, Belgium, and our company headquarters are based in the United States, in Seattle. We're not an entirely new company to the market. We have been around for around 25 years, and have been operating with various different brands, and in South Africa, that is hotels.com. Gina, I don't know if I think it's the button on the bottom with the, after the little minus sign, there's that little thing. Yeah, right. Yeah. that one right next to it. Yeah, that should be getting us to presentation mode. If it is working.
Yeah. Otherwise, Gene, if you just try and increase the display size by hiding the notes or dropping the notes, then I think that would help. But Jean-Philippe, please proceed.
Yes, I will. So if Gene, you could move to the next slide, but if not, then I'll just talk through. So we would love to introduce, of course, Expedia Group to you, our business, our brands, our presence in South Africa, how the market works, some of the competitive nature dynamics of the travel industry, how Expedia plays in that, and then lastly, some areas for discussion that have been raised by you earlier by the Competition Commission for further discussion. So, Gene, I don't know if it is possible to go to the next slide.
Yeah, doesn't seem to be working. Sorry about that.
Yeah, maybe there's something wrong with the Teams connection on sharing content, because mine actually just didn't allow to do anything, but otherwise I may have to just talk through the general story. So while we'll try to figure it out, I think the important thing is so Expedia is a global online travel company. What we focused on is really trying to focus to power all travel providers and all suppliers and bring them together. So that means we work with hotels, we work with airlines, we work with car rental companies, activities, small and big. And on the consumer side, we work with through different brands. So I'm glad that at least this slide is visible. So you can see a couple of the brands that we have in the market. So Expedia brand, which is not active in South Africa. We have hotels.com. Okay, so that was the end of the presentation.
Jean-Philippe, we're going to try to put it up from our side, but I think just carry on talking through, and while we get the technical team to do that.
Thank you. So the various other brands are in the market are US focused brands, so Travelocity and Orbitz. We also have let's see, yes, there we are. I think if we can go back one slide, please. And I think you can see our brands. If not, then I'll talk just about the side of our company. So we have around 3 million properties on our site, more than 500 airlines, 150 car rental companies, 210,000 activities plus, and a lot of cruise lines. And really our aim is to be the best company to bring the value to both sides of the equation. The travelers, most importantly, but also, of course, the suppliers who have difficulty sometimes finding their international travelers who are located everywhere, which you have to then reach in local currency with local marketing. The point to make about, let me just see if I can look at my own notes here while we have no presentation. I think it's important to know on our partner side, just to explain how we work. So yes, thank you. So these are the brands, as you can see. I have not mentioned Trivago, which is, so I will not be focusing in detail on Trivago. Trivago is a meta search company that we majority own, but not wholly own, which is operated at arm's length from Expedia Group. All the other brands are more on the transactional side. So we are the one that brings the parties together and concludes the transaction. We also have a business, and it's not a specific brand, but it's important to know, a media business, and that media business, externally known as Media Solutions, is also providing marketing function for both suppliers as well as destination marketing organizations, tourism boards. We have worked with the South African Tourism Board, and lastly, we had a corporate travel business. You can still see it here on the screen, but it is last week we divested that company called Agencia, which is now owned by American Express Global Business Travel. Perhaps, I don't know if you can go to the slide number 6. That shows our website in our activity in South Africa. So this is our brand hotels.com. As you can see, it's a localized site. The purpose, or the site allows any traveler to book travel anywhere in the world, but likewise, on the other side, we of course have our various global websites that allow bookings with South African travel providers for the international travel incoming. We work with 2 different business models. One business model allows the traveler to pay directly to our systems, and we then arrange payment with the travel supplier. The other model, and so this model we call the Expedia Collect model. The other model that we have is the Partner Collect model, where you actually go to the partner. Your booking is made, but once you actually check in, you pay at the partners, as you pay at the hotel. And then separately after the stay, there is a settlement between the partner and Expedia Group in terms of the commission. So both models are in the market, and sometimes the hotel works only with one or the other market model. Sometimes it is a mixed model, and in that case, it is up to the traveler to decide whether they want to pay now or want to pay later, and then depending on the choice of the traveler, the one of the 2 business models is executed. As I said, in a way, our third model, but it's not really business model, but that's our advertising arm, and there the revenue is not on basis of commission, but on the basis of a cost per click. So there we generate, similar to other online companies like Google, per click, and that works for the different sites globally that we have, where people can place advertisements on the site, where each of those clicks is generating money, and then flows sometimes to a destination page, sometimes directly to the travel supplier, where then the traveler concludes the transaction on the page of the travel supplier. So those 3 models we operate. I think it's also important to note how our market works is the fact that we make all of our costs upfront. If a hotel, for example, wants to work with Expedia Group, they can sign up at no cost, and they can stay with us up until a first booking occurs. Only then there is a payment, and the payment only occurs when a booking is made. So people looking at hotels but ultimately booking somewhere else, obviously that does then not trigger a payment for the partner. So it is a really a model where only when the hotel actually generates income, because there is a booking, is there a payment for the partner, so that as opposed to a cost per click model, where of course every view generates cost, but not necessarily a transaction. If you could please move to page 7, then you'll see how that works. So at the moment you do a search, you click on the hotel you would like to get more information about. You move from that listing view to the second column, where you will find further details of the hotel, the pictures, description, amenities, etc., and the different room types. Then you choose your room type, and you get to the last page, which is the checkout page, where you have a summary of your choices, your check-in, check out, what type of room, then the price with the split out the taxes and fees, and then your total price. So that's how the site flow works. You could please move to slide number 8. You were also interested, of course, in the competitive dynamic. So where do we play? I think it is important to note that in the travel industry, you have a multitude of players that are all in competition with each other. For consumers, they're often all in the same search showing up. So these are the online travel intermediaries. In this case, of course, separately, I'm mentioning here the offline travel intermediaries who are often also working with a company like Expedia. Something I should have mentioned when we were talking about our different brands. Those are the consumer-facing brands, but we also have a B2B brand, which is Expedia for Business. And Expedia for Business is providing our access to the inventory to other partners, and those could be online travel agencies who don't have their own inventory but only have a website, or it could be offline travel intermediaries who are working with us and potentially the so-called GDSs, the global distribution systems, like Amadeus or Travelport or Sabre. And we, in that same provision, are providing our products to the offline travel intermediaries, which can be standalone products or packages. We are also in the competitive landscape with tour operators, who can be both online as well as offline, but they can also be a partner of ours where we have certain content of the tour operators, which we are then providing onwards on our sites, or the other way around, where certain tour operators are partners of Expedia Group in our Expedia for Business part of the business. Clearly, we are in competition with the websites and call centers of the travel suppliers. So think about the websites of the hotels, the Marriotts, but also the smaller players where you can directly transact on those sites, and those sites would be visible either directly through the search on Google or through other meta search channels. We are in competition with wholesalers, consolidators that sometimes also operate their own websites or provide on their content to us or to others. We have, of course, the search websites that are usually the first point of call for searches, and hopefully I have the opportunity to speak about that later, because we do have some serious concerns with the way Google operates in the market. And connected to search is the vertical search, which also Google is active in, but we also have other players in that market like TripAdvisor or our own brand Trivago, and those are the meta search sites, which are the step in a way before you then conclude your transaction, but compare both inter-brand as well as intra-brand. I think we should go to slide number 9. So this is I think some of the highlights of why people partner with Expedia. It is important to notice that if you're a small South African hotel and you would like to reach a Japanese audience, a Chinese audience, a US audience, you need to have the expertise in terms of the local payment methods, local marketing, local language. And this is exactly what we bring to our partners. We allow them this access point to those markets for free, and only payment when a booking is made. But of course, we do invest upfront for our partners to make sure that their websites, their information is integrated in our website, that we translate that into those local languages, that we create the necessary payment methods for our partners. We also have a platform that is quick, so we make sure that travelers have an easy way of transacting with us, that the information of our partners is easily found, that if they have certain discounts, that those are clearly visible, but also provide insights for our partners when it comes to the performance. If a certain period of the year is an attractive period because there's a lot of demand, we give them those trends through insights, data insights, and therefore help them be more productive and more efficient in their display and in their pricing. As I said, so that those are the technology and the tools that we provide also for free, therefore, to our partners. Moving to page number 10. Of course, things have not been and are still not extremely positive for our industry. You will have spoken to many in the interviews that you've had. Our industry has been badly hit. We can say in the first month of the pandemic, we lost around 90% of our business. And so you can imagine that those are not easy days when there's no money coming in, but there are a lot of refunds to be paid out. We did our best to make sure that we were capitalized to fulfill these obligations. But as you can imagine, it is not an easy ride. Therefore, in 2020 and 2021, we had to significantly cut our resources, staffing at Expedia Group in order to make sure that we balance the income. We've lost about half of the business ultimately in the pandemic year. But at the same time, we have also taken our responsibility as much as we could to provide relief to our partners, to the people, to our travelers, through different means. Firstly, we've created a relief fund for our partners of 275 million, where we have provided credits to our partners based on their work with us in the past. We've reduced commissions, and we have provided specific marketing opportunities at reduced cost, where we were co-investing with our partners. We've created an academy for those that may no longer be in a job, but were trying to re-enter the market. People that were in the hotel industry that were without a job. So we've created courses, training, all of those travel workers that were furloughed and were part of the time at home. We hoped to create these courses to help them gain additional skills in the online world. And we also looked at our cancellation policies, getting a balance between helping our travel partners as well as our travelers in having where these possibilities existed, vouchers for the travelers, such that there was not all business lost, but also not, let's say, on the consumer side, their investment lost. So really trying to get the best for both sides as the market reopens. Moving on to 11. So as I understand, there are a couple of things that we saw that you wanted to discuss. So the first, difficulties faced by Expedia expanding and establishing itself in South Africa, issues around Google Travel, Google Flights, Google Hotels, trends around bundling, packaging, offering, consumer behavior. Question around benefits and likelihood of lower prices offered by hotels under no pricing parity, the MFN question, the OTA relationship with meta search sites, and transparency of sponsored ranking and how it has affected consumer choice. So let me start with the first one. In terms of the difficulties faced by Expedia expanding itself in South Africa, I think one of the key things, of course, I mentioned already at the beginning, is the fact that the market has been under enormous pressure. Volumes have collapsed in 2020 and are slowly recovering. A lot of markets are still to significant amount closed or require testing and quarantine requirements, that it is practically impossible to enter markets, and that creates a problem on the coming into the country of South Africa side, but it also creates problems on the leaving the country where our travelers are from, and with the potential risk of maybe having to go into quarantine when they return. And so this is a very specific and hopefully temporary difficulty, but at the moment that is a specific issue that makes it difficult to establish and invest in new markets. The other point, of course, is the fact that there is not always enough air capacity for us to bring in travelers. There needs to be enough air capacity to bring in the travelers into South Africa, and we do see that as an issue. That air capacity is not there, and you can say that's a chicken and the egg discussion, and it probably is, but it is, of course, a limiting factor. And generally the vastness of the market, and sometimes difficulties in making sure that we have the right investments in marketing the different parts of the country, and of course people will know Cape Town, but all the rest, I think there is a challenge in making sure there is opportunity. However, I can say we are in close discussions with the South African Tourism Board, and we are always ready to work to expand and establish further marketing with and for South Africa. Second point, I don't know if maybe I should stop here. I don't know if it would be helpful for you to ask questions at each of those issues, or that you would like me to talk through all of the issues and then go back to each of them. What would be more preferred?
I think finish the presentation and then we can close that presentation, and then we'll come back with questions.
Okay. So second point is related to the marketing side. So I think it is important to see that Google is the key channel for travelers to start their search. They often don't even bother typing in Expedia.com or hotels.com, but actually just type in the basis, so forget the www dot. And so that already gets us in the search engine, because I type it in the search bar, and then automatically the search engine takes over if it's not a valid email address that you type in. And then we were already in Google's search world, and often paid. And even if people type in hotels.com or Expedia, you will see branded searches appear on the top of the search results, where we actually have to pay. It's an ad, not a natural search result. But as you can see, Google is the main entry point, and is also a dominant entry point. It's a dominant search engine, market shares of more than 90%, and then funneling the traveler into their own vertical search product. So you will see on the next slide that if you do a search for hotels in Cape Town, what you will see is first the ads of Google, and those are what we call SEM, search engine marketing. And then in the former days, you would actually see the organic search results. What Google has done over the last 10 years is roll out their own verticals. But instead of actually competing on the merits on the search page, it overrides its own algorithm, and just below the ads puts a very big insert, which is the Google Meta Search Unit, where you'll see random hotels and the map. And whenever you click on any of them, you're not going to that hotel to make the booking. You're actually going to Google's own meta search page, which is in direct competition with all of us in the market. And then you type in your travel dates further, or details of the type of hotel you would like, luxury, free cancellation, etc. And then you get to the page. And then last step is that you are connected to those that are offering their or bidding on those hotels. For example, Expedia Group or others in the market. And as you can see, the flow is most people start their search on Google, then they see a screen that is filled with ads and then a map, and then way below the so-called fold, there are only these organic search results, so people don't really get there at all. Click on something flashy, so a couple of pictures of hotels or a map, automatically get transferred to Google's own OTA booking / meta search page, because you can also book on Google. And then you're actually taken all the way to the end of your choice for a specific hotel. And then the last step is the fulfillment, quote unquote, option. Is just that you're brought to, if we were bidding Expedia, and then the only page you will see on Expedia's websites is the checkout page. So what is happening to the experience of the consumer is that first they're funneled into Google through the general search page, where this big insert, this meta search unit is. And then it is a bit of a bait and switch mechanism, as I'd like to call it, where Google's then tying its vertical search product to general search. And then in the vertical search product, their hotel finder, hotel price ads product, the search functionality is of course only that of Google. So all of the investments that Expedia has made in order to have the best experience for travelers in terms of the different types of amenities, the fact that you can sort on distance to specific highlights, you can sort on the star ranking, you can sort on consumer reviews. All of that functionality that we invest in is actually not seen by consumers. So it's very possible that those consumers are actually not really ending up on the most relevant search result for them, but are only funneled by Google's product into a search result, and then lead the consumer to the checkout page at Expedia. At the same time, also, it does take out the ability for Expedia to offer the packages. We'll speak about that, I think, in some other slides. But the more consumers are funneled through this, the less they're exposed to all the other offers that we have, the ability to get a better product through the connections with an air ticket. And we do have some significant concerns with this product of Google. We think this self-referencing is problematic, and as you will very likely know, in Europe, the European Commission, European Parliament and Council are currently looking at so-called Digital Markets Act, which would make this self-referencing an illegal practice. We've also seen, and I'm pretty sure you have also seen, last week Wednesday, the decision of the European Court of Justice in Europe, having taken the decision that the Commission had it right in the shopping vertical, where Google's abuse of dominance has created similar problems, and where the Commission's fine and approach have been supported by the court. So I think it is really something that we see as a problem in the market, which will increase costs for distribution, will reduce choice for consumers, and will create issues for travel companies, because it is making it more and more difficult to get to those travelers through the investments that the companies make themselves in their own website. Perhaps moving to the next slide. So this is around the package offering. So as I said, we are providing other products as well in our offering. So you can always, if you have a flight, add a hotel. If you have a hotel, add a flight, or other activities, cars. And what is interesting for our travel suppliers is that if they have, let's say, excess supply, think about a big conference, especially these days, a big conference that's happening in Johannesburg or in Cape Town, where the hotel ultimately gets a cancellation of this conference due to certain reasons of why, and maybe it is because of the fact that a lot of people are coming from a certain market where they're not allowed to leave. That leads to problems for the fact that hotel had suddenly a lot of excess supply. Rather than putting all of that supply on the market and potentially having to decrease its price because it is creating it has a lot of supply. What hotels and other travel suppliers can do is work with us and provide us a discounted rate for packaging, which if we bundle that with another product, we could get discounts from multiple travel suppliers, where the total price is really interesting for consumers, but consumers cannot see who actually was providing that lower price. Because if you look at it standalone, the hotel or the airline or others are still able to price at their normal standard standalone rate. These combinations are therefore really interesting, but not only interesting for consumers, they're also very interesting for our travel suppliers. And that brings me to the next slide, number 16. Because those travelers often book more trips on an annual basis, so they're recurring visits. They generally book early, and that's of course important for a hotel, because it helps them revenue manage. They spend more. They stay twice as long. And they are a lot less likely to cancel, around, I think, 40% less likely to cancel. And standalone, therefore, is shorter, booked more shorter before the actual stay, and have a higher likelihood of being cancelled. And that's why this actually is a very interesting product for our travel partners and for the traveler. And these products are, of course, when you come back to the earlier issue, not going to be accessible for travelers when they through Google's channels. To the next question, number 17. So this is the benefits, likelihood of lower prices offered by hotels under no pricing parity that outweighs the cost and likelihood of the free riding. I think the real important point, as I said in the beginning, is that none of our partners actually has to pay anything up front, but we have to make sure that we put the investment in translating the websites or the content of the travel partner, the hotel, making sure we enable the local payment methods, and invest for our partners. About half of what we make, we invest in marketing, and that is, of course, to a large extent on search. Those are all costs that are then taken by us, but there's no payment for any of our partners, only up until a booking is made. You can imagine that if it is always cheaper to book direct, then our investments are in a way done to attract those travelers so that they can see the pictures, the reviews, the availability, the pricing, and then they therefore afterwards look directly for that hotel partner and book direct. And that is an unsustainable business model. In addition to this, there are, of course, travelers that are not able to find all of these alternatives. And for those travelers, it is in a way also trying to limit the discrimination of those travelers that are not so savvy in comparing, that they would always be paying more than the actual price. And I think it is important to note that we've seen that in various other markets that the price that a hotel was offering when there was this discussion about whether a higher or lower rate should be on one or the other channel, that it was often just the fact that they increased the price on the online travel agency, and so it wasn't directly really benefiting the traveler. It was only just increasing the price on the OTA channel. I think the free riding element is an important point that needs to be balanced, and it has been balanced over the last, I would say, 8 years by the different competition authorities. And I think they have landed on the fact that there is a good balance to be found between allowing the hotels to provide a lower rate when people call them, when people walk in, when people email them, so all the offline world, or are in their own loyalty program, but that there's still significant justification to offset the negative effects of free riding when it comes to their own distribution channel. So that would be the differentiation between what we would call a narrow MFN and a wide MFN, where wide MFN we do not currently have in South Africa. So it is allowed for a hotel to price differently on different channels, different online travel agencies. They can price whatever they want on their own offline channel, their walk-in, but when it comes to their own online website, and then not their loyalty part of the website, but their public-facing part of the website, that is where the biggest risk of free riding is, and that is where we ask our travelers not to be discriminated against when it comes to pricing. Coming to point number 18, or the slide number 18, the relationship with meta search sites, meta search as a route to market. As I said, we do work with the meta sites. We actually have our own meta site, as you could see with Trivago. The biggest issue is when meta search actually owns general search, and I already highlighted this point. This is where those two markets are tied, where general search is then automatically connected to meta search by Google in their hotel price ads meta search product, and also therefore making life difficult for any other meta player to be visible. So the consequence of this behavior is now that we also have a situation where Trivago is then participating inside of the Google hotel price ads product, which then after that still, so it's a meta on a meta. So our concern is not so much what happens in the meta product, but the fact that Google is able to self-preference in the general search results. And that's where a remedy needs to be applied. Number 19, if I may. You've asked about the transparency of the ranking. And I think it is important to describe how our ranking works. So first of all, when we provide a response to a search, the traveler has the ability to sort by different ways. As you can see here on the screen, there some of them are mentioned, not all, but you see it says sort by, featured, star ranking, distance. You can rank by consumer reviews. You can rank by star ranking, all of those, and of course by price. Those are all different sort functionality that the consumer has. The featured one is what we consider to be the best value for money overview for a consumer. And so how does that work? We have two main factors in the sort in the featured. It is the competitiveness of the offer, and it is the quality score of the hotel. The competitiveness of the offer is, of course, looking at it. Is that hotel in that area, in that time of year, a good deal? Meaning, so we're not comparing a 4-star hotel near the airport in Johannesburg to a 4-star hotel in the center, but we're comparing the competitiveness of that offer, of that hotel, to its peers in that area. And with that, it gets a certain score. And each of the hotel types will get a score. So you can have a very competitive 2-star hotel, or you can have a very competitive 5-star hotel. They'll both be valued similarly on the on that element of the sort of the ranking algorithm. The other element is the quality score, meaning is that hotel valued by travelers? Good consumer reviews? Have we had problems with that hotel, for example, double booking or consumer complaints calling our call center? All of those points get into the algorithm, and then the combination provides a location in the ranking. At a certain point, those two factors could lead to a certain hotel, a 5-star hotel, being in a certain spot, and another 4-star hotel that is completely in another part of the area being in the same bandwidth. And if those hotels are the same when it comes to their value for money for travelers, meaning in terms of the assessment of their competitiveness and in terms of the assessment of the quality of the hotel. Then our algorithm takes into account a tiebreaker. That's when a tiebreaker comes into play, and that is the compensation that a hotel pays to us. So the moment that actually it makes no real difference to a consumer because they're all in the same bandwidth of value for money, then it is compensation that breaks a tie. But it is not possible for a hotel to pay us such they can trump another hotel that actually has a lot better value for money and a lot higher quality score. So you cannot buy yourself to the top. It is only to make sure that there is an ability to break the tie for those hotels that are similarly ranked. We are disclosing clearly to our travelers how this works. So you can see the big text underneath. How much we get paid influences your sort order, which then provides a whole lot of detail once you click on that, which as you can see here now on the screen, which is the information that I just explained to you as well. If you can move please to the next page, number 20. So we also have specific advertisements. So and just to be clear, these hotels are not paying us commission, but these are paying on a cost per click basis. So this is really an ad. And those are then clearly marked to consumers as an ad. So consumers could see when those listings are in fact paid for directly by the hotel to be there, where they pay if somebody clicks on them, versus those that are part of our sort order. I think that is it. That is our last slide. Thank you very much for the time to take you through this, and I'm happy to answer any questions you have.
I think it's my turn now to try your surname. Good afternoon, Jean-Philippe Monod. I hope I got it right.
Wonderful. Absolutely.
Thank you so much for that presentation and for providing us with insights of Expedia. We really appreciate that, and we appreciate your time. I just want to start with you in your presentation. You referred to your parity as a narrow parity price in South Africa. I just wanted you to be clear on that, because our understanding was it is a wide parity, and I just want to be clear that we understand each other. Is it a wide parity or not?
Yeah, so in South Africa, our contracts, if you sign up to Expedia, you have a narrow parity only, and there is no wide parity. And I'm talking about hotels here in specific. I cannot speak in general for airlines because these are all very bespoke contracts, and also the market dynamics are very different in air. The discussions with airlines are different when it comes to parity, but when it comes to hotel, we do not have a wide MFN, but for the air side, we still do. If that is
yes,
is applicable or not.
Yes, thank you, Mr. Monod. On the contracts we have, and I guess that's why we wanted to go straight here, is that our understanding are those are wide parity, the clauses there are wide parity clauses. But we quite comfortable if you saying if in your view those may be old contracts and the contracts that currently prevail are narrow parity. Is that what you
Yes,
say?
that is correct.
I think what we will do is we will look at the contract and we may have to come back to you to just confirm that, and maybe we may have to ask for
Yes.
the contracts that contain the narrow parity clauses, if we could get
Yes.
that. Yes, thank you so much. I'm going to come back to these questions on parity clauses and in particular narrow or wide. But before I start here, I just wanted to go to where you say the consumer journey begins, which is in search. And if I recall in your presentation, you state that 55% of the journey essentially starts in search, and in particular in Google. I wanted to ask you, Jean-Philippe, if you don't mind me, I think that would be easier for me to call you by your name. Are you comfortable with that?
Yes, please.
Okay, thank you.
Yes, please. And yeah, you can also say JP if
Oh, that's even perfect.
that's easiest.
You can call me Doris. I'm also happy with that. I know it would be easy. I just,
Thank you, Doris. That makes it easier for both of us.
my surname is Tepe. I don't know if you want to attempt, but that's fine.
Tepe.
Yes,
Tepe.
Tepe. Yes, oh, that is perfect. Yes, thank you. I just wanted to know, do you have some of the stats on this journey? I mean, I wanted to know how many of consumers who start on the Google search would maybe click on the ads as opposed to the unit or the organic search. Do you have any of those stats?
We absolutely do have these stats. So of course, only when it comes to our clicks. So we know when people come into Expedia through search engine marketing. So that's when they click on an ad. We know if consumers come in through the general search algorithm, so what we call SEO. We also know if they come in through Google Hotel Finder, Google Hotel Price Ads, which is the meta channel. We also know if they come to us directly or through other meta channels. I know that we shared with you a lot of data following your request. I'm not sure, I don't think this was part of it, but we are very willing to follow up with you on that and look at the data when it comes to the travel vertical, the travelers coming into our sites in South Africa.
That would be very helpful. I don't think the information we have includes this, and if you could, that would be great, because part of what we also wanted to understand is how many of them would go below the fold, for example. So if you are able to, with your data, provide those to us, we would be grateful.
Yes, no, we can certainly look into that and see also perhaps if we can give you a trend over time, because that I think is probably the most interesting to see what's happened over time with the SEO traffic and the meta traffic and the SEM traffic.
You just took us through, Jean-Philippe, how the Google Travel and how it looks when you go in. I just wanted to ask you, what has been the effect of Google Travel on organic search and on paid results from your point of view?
Well, so the first thing that happened. So if you look at what the changes were to the page, I don't have here an overview, but and if I had it, I probably couldn't share it, unfortunately, because of the technical difficulties. But you will probably recall the days that Google had a blue box on top.
Yes.
So what happened is that over time, the blue box got another color, got faded, and sort of the color completely disappeared. Then there was a big bright green word saying "ad." Then that word changed into black and was inversed. So now it's just two words, "ad," as you could see on my slide.
Yes.
What has happened over time is that consumers have been conditioned to believe that all of the search results are in fact organic. So in former days, it was very clear when something was an ad because it was blue in a blue colored box. With all of that disappearing and organic search results being sort of more blended with the ads, consumers don't really see the difference. And then with that, now you have on top of the search page, you have the ads, where consumers don't really always consider that to be an ad, even though I know it says ad, but it's because people have been more conditioned in general search, because they knew they were just asking a general question to get these ads automatically on the top. What Google later has done then, so you first had the ads and then the general search results, has inserted between these ads and the general search results this big box. So what this box has done, it has first of all functioned as a bait and switch mechanism where people click and then are taken to another page, which is then people are captive in Google's meta world. But it also at the same time has pushed down the organic search results even further below the screen because of the size of that box. And so you could see that it has even pushed the normal search results sometimes onto the next page. And so I think since the introduction, and they have played around with the size of this box. First, it was a couple of links, then they created the pictures, and so the box became bigger and bigger. And now it is this full-fledged box with pictures and the map. That has, I think, created for all travelers a screen that does not actually see any SEO results unless you have very small resolution or high resolution, very small font size. Then in your screen you could still actually see it. But for those that are getting a little bit older, like myself, I don't have that very small font size on my screen, and so you really only see the ads and the box, and that has had, of course, significant impact on this on the SEO traffic. One thing I should mention that is a really important dynamic is that travelers are more and more making their searches and their reservations through mobile, and so you can imagine that this problem is only growing when people are going through smaller screens, because if you've got the ads and then a box on a very small mobile phone screen or a tablet screen, then you're very likely to see no organic search results at all, as even compared to desktop, where the problem is already quite significant.
Given that Google Travel is a meta search and not an OTA, is one of your concern or one of your main concern that in fact what it has done is effectively adding to add costs of other OTAs?
Yes, so I think it has definitely created additional cost, because it just creates an additional step. Google's product is mainly a meta product, but it does have a booking functionality. So if you look on Google for book on Google, you will see an explanation on how that works. So that then you actually never have to leave the Google world, the infrastructure, and you don't even go to that last step of transaction on, for example, our site. But they're mainly a meta, indeed, on a cost per click basis, but they also have this booking functionality. So they're really a blend, and it creates, I think, two problems. One is it creates additional cost with a questionable added value to consumers and suppliers. And secondly, I think it reduces choice for travelers, because if you're mostly going through Google's own meta product, then you will never see any of the investments in technology, the innovations of any of the travel agents that are that have a good website, a good ability for travelers to find the right offers, because you're always automatically going to that last page at the checkout. So on Expedia, if you're going through the Google funnel, you go through general search, you click on that box, you go to Google's meta page, you do the search again, you go through until the booking button, and then once you click book, you're transferred to our last checkout page. So all of the path of searching on Expedia, the reviews, the alternative options, the packages, etc., are not visible to you.
Thank you, JP. Just so I can, you've raised a number of issues regarding a Google search or Google Travel or Google with its many other products. And you also referred to the ECJ judgment. I just wanted us to explore a bit on recommendations that you may have on how we should address this. As you know, one of the mandate of the inquiry is, if we were to find that there are issues, we may recommend remedies, and we wanting to explore with various participants in the inquiry on those possible remedies. And I just wanted to start with you on that, if you don't mind. So yeah, so the first question I had is, if this is about position, and so you will correct me as to, this is where the ad is, and then you have the box for Google Travel, and then organic search results may come either below the fold or even on the next page, depending on the screen. Should we be looking to bump up organic search to the top, or what would be your proposal in that regard?
Well, I think the issue is that Google is blending two different markets. So there is general search, and you can think about that what you want, but the fact that they have built this product and that they are where they are is something to be positive about, right? I mean, they have invested, they have a good product. I'm not talking about the fact that they're in competition with other search engines. That competition needs to happen, but I'm talking about that level below. I'm talking on Google, because they are a dominant player. They have an ability to foreclose the market and to tie general search to vertical search. And so there, I do also see that you cannot have a product that is only general search SEO results, because that's obviously not a product that would be able to be sustainable, because I know there are some ads are necessary. But where the issue is between the ads and the general search. It's this box. So the box is placed there by self-preferencing. It is not placed there because Google's product is the best product. So we think that competition should take place on the merits when it comes to verticals. And that means that Google's vertical is just one of the many options. So either Google's vertical needs to go through the same algorithmic test and potentially end up on page 3 or wherever, depending on how they rank against others. Or Google needs to create a mechanism that everybody can compete in an equal manner. So their own vertical needs to be given an equal display opportunity as competitors based maybe on organic criteria. So you could say, well, if there's a more rich format for this box, then competitors to Google need to get the same richness in that display. And that's what the Commission is now also proposing in terms of the ranking, so that self-preferencing is not allowed, not only by the location, because that I think is one point, the fact that this box is automatically on top of the general search results, but also the size of the box. So it would not be helpful if Google was just allowed to continue to keep its box. It is also about the fact that if competition is taking place on the merits, then that box needs to be provided in an equal manner to competitors. So then that box needs to show a certain space for Google's meta, but and OTA page, but equally to the others. So once they do show that box, and I'm not saying that I'm not against innovation, and I think that's often what is used as the counters, like, oh well, you know, we're just going back in time. We're not going back in time. I'm pretty sure that Google is able to come up with a solution that allows for competition to take place on the merits, where that box allows competitors equal visibility. And that, I think, is the remedy. And how do you get to that remedy? Well, that is through making sure that self-preferencing is prohibited.
Thank you. I just on that, Google says that that box is basically as a result, it comes from organic search results, and therefore it's almost like they are providing that based on organic search results. What is your view on that?
Well, that's an interesting statement, because if that were true, and then you could just link off from that box to whatever, that hotel, and then that hotel would conclude the transaction. But that is, of course, not happening. As you will be able to find out yourself, the moment that you click somewhere in that box, you're going to Google's vertical page. You're not going to results. You're just, it is, as I said, it's bait and switch. There's nothing organic. If you type in hotel Cape Town, then you will see 3 random hotels. But if you then ask yourself, is that the hotel I want to stay at? Is it available in the day that I'm going? Is it the amount of star ranking that I'm looking for? Is it in the location where I'm looking for? Those, whatever, 3 or 4 pictures of hotels are not your answer. So what do? You click on the map, because you want to actually do a vertical search. And that's the whole point. Vertical search needs more input. You need the dates. You need to know where they want to go, when, what level of the hotel. All of that information is needed to provide a relevant answer. So if Google says that they can answer the consumer's query on the general search page, that is simply not true.
Thank you. I was just being shown the contract, and it does look like a wide parity, but we have spoken about that, and we will get whatever new contracts you may have with the narrow parity, if you may. I wanted to just You spoke about this box, what I call a unit, where all meta search and all OTAs are given an opportunity to compete freely there, so that Google competes with all of that. Is that the proposal you have in mind, or to the box that currently is? Or that Google has currently transfixed between the ads and the organic search?
Yes, I think it is important to look at what the answer to the query is for a traveler. So the answer. So if they say, I'd like to know, I'd like to book a hotel in Johannesburg, then what Google's answer to that question is, well, how can I help you the best way to make a booking? Therefore, that would not be to provide one simple hotel, because that's not an answer to the consumer's query. He wants to be able to book a hotel. So that is very likely travel agents or comparison websites, other meta sites. That's the answer. So, and that's what you will see if you type in that query. That's the organic search you will see. So it is very logical that Google then has to take those results that come from organic into account when they provide an alternative way of display for those results in whatever is put between the ads and the organic search results. Because they, in a way, what they say is, well, we are the most relevant search result for a query, and so click on us and we'll take you to our product. That's what they do with their box. But I think what we need to make sure is that if they still are going to be on that number one spot, well, then competitors need to have an equal access to that location, and equally when it comes to the display. So it can't be that Google has a whole nice box and that somewhere hidden how you can, or that you've got a couple of logos, which what Google's currently testing, a couple of logos around the box where nobody is actually clicking. I mean, that's not a allowing competition on the merits to take place if you are dominant and you are abusing your dominance. So it is really important that around that box there is an equal display.
Thank you for that. Just another issue I wanted to raise with regards to what could possible remedies is, you've referred to the Google Shopping case. Price comparators, comparative websites have criticized the solution on the Google Shopping case of bidding for a place in the unit box. And I just wanted to understand what your view is, because in their mind, you have to pay to be there, and Google does not essentially have to pay. What is your view about that, and do you see it working, the Google Shop solution?
It's a good question.
Based on what you just said. Yes, sorry.
Yes, so there is one difference between the way the travel vertical works and the shopping vertical works, is that if you are on the page for the shopping vertical, you are actually, when you click on a product, you're not actually connected to the meta search player, but you're going straight to the seller, right? So think about, so there's a meta search player that's bidding on Google, and they get a certain slot in the product ads. But once you click on that, you're not actually connected to the meta search player, but you're connected directly to the seller of that product. So the different dynamic on the travel sector is that just simply doesn't work, that model, because on the general search results page, you cannot just show 4 pictures of hotels, because no traveler is going to say, okay, I'm going to click on a hotel and go straight to the checkout, right? That's because you haven't even told them when and where and how many stars. And so there's so many other questions that you need to ask. or answer, you need actually the consumer to be in that other meta search page. So that's why Google's solution for travel is different in a way, by pushing everybody into the other page. I think that when you look at a remedy in this case, it is about a mechanism where competing verticals would have visibility, so that people can actually go from that page to the vertical or the online travel agency, because they're in a way in the same market, where then the consumer can continue his search by saying, I want to go this day, and this is the area, etc. So I think that the remedy discussion around shopping is slightly different than the remedy discussion around travel, but the abuse is the same.
Thank you. I just have one question on this, and that what would be the impact of all these remedies that we're discussing currently on local platforms? And essentially, my question is: do you think they are likely to benefit companies like Expedia and Booking, who are bigger platforms compared to the local platforms?
No, I think it will ultimately benefit those platforms that are the most relevant search results for the traveler. And that means if a local platform has the best supply and has the best review for those results, and Google, and that's what Google's normal algorithm does. It scans the world and sees what consumers find relevant results. So if consumers find these players the most relevant results, those are the ones that then would show up in that remedy. And so it's all about the relevance and the investments that these companies make to consumers. And those local players that are the relevant search results should then get the necessary visibility in that remedy. That is what happens just below the ad, and equally, you can see, well, who are the most relevant search results by looking at the organic search results that follow from a query, and that could very well be those local players.
Yeah, I won't deal much with this. I think I've spent a bit of time on it, but the only issue is that even with organic search, you're finding the bigger platforms, and I imagine that there is still a lot of, you spoke about the investment part, which is the marketing cost component, that for local partners to try and compete with bigger and international platforms like a Booking or an Expedia become still difficult. So I think it's something we still need to engage a bit more on. I don't know if you want to comment on that before we move on.
Well, I think that the big difference when it comes to display is the top side, where you have the ads. That's obviously a market where it matters how you bid. But the organic search results show the most relevant search results for the traveler, meaning travelers have looked at that, clicked on that, and found it relevant. And I think that's where, yes, I agree with you that also investments in becoming relevant are important. But that is a choice. That is, in a way, the consumer benefit is to make sure that the most relevant company would then show up in the general search results. And I think that if there are local players that are the most relevant search results in, for example, making sure that you have that you can make a trip through different parts of South Africa, it is those companies that invest in that, as opposed to maybe the international players, that could become the more relevant search results when consumers are looking for that. So that, I think, is the difference between the top side of the screen, where Google is monetizing through advertisement, search engine marketing, and the bottom part of the screen, where the most relevant search result should get more visibility, including any player, any local player, anybody that is providing a service that would be best for consumers.
Thank you, JP. As I said, I think time is running out, and I'm going to move from this. I was going to discuss with you wide parity clauses, but after what you've just said, I'm not going to engage on that, and we will receive your contract, and if there's anything we want to raise, we will then deal with it then. But what I'm going to try and discuss is the narrow parity clauses. I mean, what I wanted to find out from you is if they have actually, these clauses have been put in place in order to prevent free riding, where is evidence on free riding? We have not been provided with much other than assertions that we have had over time. One of the evidence we received from one of the participants in South Africa was that there is less than 1% of free riding in their experience, for example. So we would be interested to know this. I know that in Germany, they found that consumers tend to look where they start the journey, and 99% of that is on booking. So those two evidence actually do not so much indicate free riding, but more, or to the extent that there is very minuscule. Do you have any comments on that, or do you have any evidence that you could show us?
Yes, certainly. So I'm just seeing if I can find some of the statistics that. So there was also a study done by the CMA in the United Kingdom that looked at comparison tools, and they found that consumers looking to book hotel accommodation visited on average 3 comparison sites, and about 59 of consumers shopping around for hotels visited the hotel's direct websites. So that comes to show that consumers, for close to 60%, actually do go to the direct website. We also have done some studies around what we call the so-called billboard effect. So consumers do look at multiple sites, but they start, of course, on an aggregation site, so that they can actually find out where they want to stay, if it is available, and what price range, look at the pictures, look at the reviews, and then they go to these hotels. And obviously, a lot of these consumers ultimately make their booking there, and it does happen, and that is the free riding, and it is part of the market. But I think the fact that it is happening is something that creates the free riding, given that our business model is only to get paid when a booking takes place through our website. The fact that a lot of people visit our site, use it to find the right option, but then ultimately make a booking somewhere else, is something we have to live with. But it is, of course, if that becomes too big of an impact, creating a model that is not sustainable. So I think there's quite a lot of evidence around the billboard effect, and this study that was, and I think I can mention to you the so it was done by the CMA, but it was an external study. It might actually be on their website still, because it was done in, so it's a 2017 Kantar public study, and it was done as part of their their market study, which you may have access to. But if you are interested, I can also see if I can send you the copy of the study.
Thank you. That would be good. But in South Africa, I mean, as I said, one of the participants who actually is a platform and do not have a parity clause said that in their experience, there's very little, if any, happening in the country.
Yeah, so I think the bigger marketing investments you make and the more visibility you have, the larger the free riding effect, right? Because consumers then say, oh, well, you can use Expedia for just finding out what the options are, and then go somewhere else. And the more visible you are, the more marketing dollars you pay, the more likely it is that you are then that website that people use to do their initial checking and then move on to do some further detailed checking by using the hotel names, etc., that they find on our sites.
Yeah. Thank you, JP. Look, I mean, the just with regard to the CMA study, I mean, I don't know, we will have to look at it, because from what you're explaining, it could be that consumers do go there, but they still go back to the OTA, to the site they trust and book. So I think maybe we just, before I engage and explore further with you, it would be useful for us to have a look at that. Yeah. Thank you. Just also with regards to still with the narrow parity, I see in your quality score, you include that based on Expedia, you check whether the prices on Expedia or elsewhere are any different, and essentially an accommodation provider could be punished for having lower prices elsewhere other than on Expedia. Am I correct?
Well, I don't think you are looking at from, or should be looking at it from that perspective. I think you should look at it perspective from those hotels that want to compete in the market with an interesting rate in their competition with other hotels. And it is those hotels that we look at if they're a good value for money deal on Expedia. And so it is both in the interest of the traveler that those offers actually are visible, because those are the best deals for consumers, as well as for those partners that are in competition with other hotels, that those offers that are strong offers, good deal for consumers, are not pushed down by those offers that are not interesting for consumers. It would be a very strange situation if a bad deal, if you say, if you know that on Expedia you have a very high price and you can book it cheaper on the hotel's direct channel or with a local South African other OTA or anybody else, and we have a bad price, we don't want to to have that price push down those deals that are really good for consumers. So, and that's how ranking works, right? It is not about punishment. It is about the fact that good deals are the ones that are above the bad deals. And so, yeah, you automatically have a ranking, and there's only one place where you can be, and so it has nothing to do with our comparison. It is just making sure that those right deals, those good deals for consumers, that are more visible for consumers, because we want those consumers to have a good our partners to have a good experience because they have the good deals, and people on Expedia that they actually don't feel that they made a booking and then later found out that that is actually cheaper everywhere else, right? So that would not be a good experience on Expedia. That will reduce consumers coming to us and reduce our effectiveness.
Thanks, JP. But that is the point. Is if that is the effect, then why do you then have a narrow parity? If in your quality score you cater for that differentiation.
Well, our algorithm looks at things more generally, and any hotel that wants to compete on other channels can provide us with any rate that we want, that they want, as compared to competition, and they make their choices, right? We don't make the choices. If they have a rate that is not competitive, well, then other hotels may have rates that are more competitive. But the narrow point, we do find that very specifically to their direct channel is something where we see the free riding happening, and that's where we want to make sure that that there is that there's no free riding happening on that specific channel. But generally, I mean, hotels are free to provide any price to any player in the market, and if we get the worst and others get the best, well, that's what the market is, right? If there are other hotels that do have really good deals for consumers, those are the ones that get more visibility. Separate from the discussion about free riding on the direct channel.
Thank you, JP. I've just been reminded by the chair that my conversation with you has taken way longer than anticipated.
I'm very sorry.
No, don't worry. It has been very useful. I actually wanted us to touch on ranking on your own platform, and unfortunately, I won't have the time to do so. But I think at some point we may want to engage with you on that. I'm just going to go on to just your plans and experience elsewhere, because I just think it's something as an inquiry we're interested in, and that is just to understand how you started and then went into just in the other international markets. I mean, in our understanding, being based in the US. You started focusing on U.S. Travelers on their journey elsewhere. Is that correct?
Yes, so that is correct. I think that as compared to certain others in the market, I think we are bringing a lot of international travelers into the markets that we work with. So we are mostly a company that brings into South Africa international travelers, rather than focusing very much on the domestic market. Our investments, of course, are such that we have the necessary supply. It starts, of course, with having the supply. So we are working in South Africa to make sure that we have an interesting offering for them. We bring in a lot of the American travelers. We're of course, that's our home market. So I think it starts to be competitive, to make sure that we have the key markets when it comes to supply, that we have the key cities, but also the smaller cities in South Africa, and that requires investment, because you need to have an outreach to those partners, and you need to make sure that they see the value of working with Expedia. Once we have that, of course, we need to make sure that we invest in the positioning of all of those partners internationally. So translate the content of all of our South African partners into 70 different languages. or 70 different sites. I think we have about 25 different languages. Once we have that, then we need to make sure that we are able to compete in the market for the demand. And so we need to identify, okay, where is the demand of people wanting to go to South Africa? And then we need to invest in those markets that are key feeder markets to South Africa in our marketing online, whether that is Google or other meta channels, or do campaigns in certain offline markets or on television. And that's where we are looking for opportunities to work with the South African Tourism Board to see, okay, what are the key feeder markets where we have a strong presence? Where can we work together with insights? Where can we co-invest in marketing? And I think that's the next step. So having that next step on with South African tourism would be important. Of course, the trends now, and I do realize that this is a strange world we're currently living in. It is not like 2019. We currently have to be clever and quick, and that's why I think Expedia Group can be a good partner to South African tourism, because we do see the trends. And when I mean the trends, it's the search behavior. We see the search behavior starting in certain markets for South Africa. And then with that can come the investment to actually do the promotions and work with our partners to provide good offers on the right moment. And we have the insights of when are travelers going, when are they looking, and where are those people that are actually looking or booking, and then making sure that the marketing investments are done most efficiently. So it is a bit of the chicken and the egg, because unfortunately a lot of markets are still closed, and therefore there's little appetite to put a lot of advertising in if you know that people can't come. And that's where we're in. I think it is a bit of that harmonica, unfortunately, where we're currently in when it comes to investment, because I would love to make sure that we can bring, as Expedia Group, as many international travelers into South Africa. But it needs to be possible. There needs to be no quarantines, and so we have that information. We're monitoring that closely. And that's something, maybe an added value in working with South African partners, to make sure that that information is shared.
Thank you. I have one last question, and could I ask you, just because I know some of the panel and the technical team members may want to ask some question, but and this is from your experience operating in a number of markets globally. And what I wanted to find out is where you and the other bigger platforms have entered various markets. What has happened to the smaller local platforms in those destination or the origin countries? Have they survived, or are they outgunned by the bigger platform? And also, how do you position the domestic traveler in that?
Yes, so I think there's absolutely
JP, if
value.
I could ask you, I'm sorry, if I could ask you to be short in your answer, just so
Yes.
without limiting what you want to say. I'm very sorry about that.
Yes, of course. No, I see time is ticking. Very briefly, I think there is absolutely a place for local players. So it is not that we are in a way coming into market and that then there's no more place for local players offline or online. Actually, it is a large share of our business, as I may have said in the beginning of the presentation. Expedia for Business is an important partner to the offline and online travel agents. So they actually work with us where we are providers of the international supply or local supply, depending on the supply that they don't have. And that completes their offering, and they are then able to advertise themselves, and we split the commission. And that happens with offline travel agents as well, that want to offer packages, want to offer lodging or air. They are our partners. So I think the fact that we are entering a market is also creating hopefully opportunities for our partners to be then more specialized, right? So there can be partners that are focusing on specific parts of South Africa or specific types of travelers. Could be families, could be travelers that want to bring animals, and they can look at, for example, the supply that we have, focus on those, and be the leader in that. But they're still partnering with us. They don't have to get all the contracts with those hotels or airlines. And so there are opportunities to work together. I'm not saying that there's no competition, of course, when you just want to fly in and out of Cape Town, right? I think that, let's be honest, that is a weekend trip. But there is absolutely a place for international companies to work with the local companies. And we actually do. The evidence is that we do. Hopefully that was short enough. I mean, I could talk about it a lot longer, but I think we do see those companies as our partners as well.
Thank you, JP. Sorry, Chair, I'll hand over to you.
Thanks, JP. I just got one last question, then we'll close the session. I mean, obviously we've had this confusion over wide and narrow parity, but I mean, regardless of where we end up, if it is a wide parity clause, do we have your commitment to then make it a narrow parity, because you seem comfortable with that?
Absolutely. We do not have a wide parity clause in our standard contract, and I'm happy to share that with you.
No, I know we've got the contract. I'm saying, if it's found to be wide, would you be committing to making it narrow? Because there is some confusion.
Well, yes, if we have the same definition of wide, then absolutely. So wide meaning on different on other channels than your own, also including so wide meaning what we do allow is the offline channel, walk-ins, emails, and the private channel. Let's say the loyalty program. So we're on what we consider to be narrow parity is the publicly facing online website of the partner. That is what we consider narrow. That's the only thing that we would contain, and everything else is not in the contract.
Yeah, and wide would be other platforms, other online platforms.
Yes, exactly.
So I'm just indicating that we'll obviously sort this out offline, but if it is found to include that wider group, then do we have your commitment to change those to make them narrow, because you seem comfortable with narrow?
Yes.
Great, thank you. I am going to call the session to a close. I want to thank you, Jean-Philippe, for making time. I'm sure now that markets are starting to open up, it's become a little busier for Expedia and the travel industry. And I hope that there is a recovery, because this has certainly devastated the industry, and many of these local establishments and global ones, I'm sure, are waiting to welcome tourists back, and hopefully your platform and the others will facilitate that. So thank you very much for coming to join us.
Thank you for your time, and we sincerely hope that we can enhance our cooperation with South Africa, bringing back tourism and helping everybody in the industry to recover.
Yep, we certainly hope so. We need tourists. Just for a general announcement for tomorrow, we did have Jeff Manning from 0800 Properties having a technical issue, so we are including him at 9:30. So we're going to start 30 minutes earlier tomorrow than we would otherwise, to fit in Mr. Manning. Then the rest of the morning session would be my property and private property, and then the afternoon session would be property 24. So that would start at 2 o'clock. So thank you, and we'll see everyone tomorrow at 9:30 a.m.
Thank you.